Good evening. Tonight, we bring you an extraordinary special report on what many economists are calling the most significant financial upheaval in half a century. The United States dollar, once the unshakable bedrock of global commerce, is experiencing a crisis of confidence unlike anything witnessed since the collapse of the Bretton Woods system. This is not speculation. This is not theory. This is happening right now. In 2025, the dollar suffered its worst annual decline since 2017, falling over 9%. But that masks a more terrifying reality beneath the surface. The dollar index plummeted 10.8% in just the first 6 months of 2025, the worst first-half performance since 1973, when the post-war monetary order was crumbling in real time. Think about that for a moment. 52 years. That's how long it's been since America's currency took such a devastating blow in such a short time frame. And unlike 1973, this isn't a coordinated policy move like the Plaza Accord. It's a symptom of deeper structural problems. Morgan Stanley economists project U.S. growth will slow to just 1.5% this year and a mere 1% in 2026, down from 2.8% in 2024. Meanwhile, as of August 2025, U.S. federal debt reached a staggering $37.3 trillion, a historic high. The world's reserve currency is bleeding out, and the hemorrhaging shows no signs of stopping. While the dollar drowns, something remarkable, something historic, is taking place in vaults across the globe. Central banks worldwide are engaged in the most aggressive gold-buying spree in modern history. In 2025, central banks purchased 863 tons of gold, extending a pattern where banks have bought over 1,000 tons annually for 3 consecutive years from 2022 to 2024. To put this in perspective, between 2010 and 2021, central banks increased their gold holdings by an average of just 473 tons annually. They've more than doubled their appetite for the yellow metal. Who's leading this charge? Poland topped the buying list for the second year running, adding 102 tons in 2025. Brazil re-entered the gold market after a 4-year absence, adding 43 tons between September and November. Kazakhstan purchased 57 tons, its highest level of buying on record dating back to 1993. Even China, despite reporting modest official purchases, continues its relentless accumulation. The People's Bank of China added 27 tons in 2025, bringing its reported reserves to 2,306 tons, accounting for almost 9% of total reserves. But here's what should terrify American policymakers. Gold demand by central banks accounted for more than 20% of global demand in 2024, compared to around 1/10 on average in the 2010s. The message is unmistakable. The world's central bankers are voting with their vaults, and they're voting against the dollar. But we've heard this before, some might say. People have been predicting the dollar's demise for decades. You're right to be skeptical, but this time, the warning signs are different, more ominous, more systemic. The 2022 freezing of $300 billion in Russian central bank assets sent shockwaves through the global financial system, prompting nations to reconsider their vulnerability to sanctions. Suddenly, holding dollars wasn't just an economic decision. It became a geopolitical gamble. Goldman Sachs now forecasts the dollar will slide 10% against the euro and 9% versus the yen, a dramatic reversal from earlier predictions. J.P. Morgan reports that U.S. 2025 consensus growth estimates fell from 2.3% to 1.4% during March and April, reflecting deep uncertainty about America's economic trajectory. Adding fuel to the fire, President Trump's attacks have raised worries over Federal Reserve independence, further undermining global confidence in the dollar. Comments about potentially firing Fed Chair Powell on July 16th led to a 1.2% drop in the dollar within an hour. When a single presidential comment can crater your currency in 60 minutes, you don't have a monetary policy problem. You have a legitimacy crisis. Here's the part that should keep every American awake at night. Previous financial crises: 2008, the Asian financial crisis of 1997, the Latin American debt crises. These were exported around the globe. When America sneezed, the world caught pneumonia. But what we're facing now is fundamentally different. The euro has risen 13% to above $1.17 as investors focus on growth risks inside the U.S. rather than abroad. European-focused ETFs received a record $42 billion in net flows year-to-date as of July, while non-US ETFs investing in US equities averaged only $5.7 billion compared to $10.2 billion in the same period of 2024. Capital isn't just moving away from America, it's running. More than $5 trillion was erased from the S&P 500 in the 3 days after Trump's Liberation Day tariff announcement. U.S. Treasury markets saw massive sell-offs, driving up borrowing costs for the government at precisely the moment when the Congressional Budget Office projects $3.4 trillion in cumulative deficits over the next decade. This isn't a global financial crisis spreading outward from America. This is an American financial crisis, and the rest of the world is watching from a safe distance, protecting themselves with gold and alternative currencies. Make no mistake, we're not predicting the dollar will disappear tomorrow. The dollar remains the world's reserve currency, supported by U.S. market depth and safe haven status. There are few signs that major foreign holders are poised to suddenly shift away from U.S. dollars, and there are few other currencies that could take its place. But a sudden collapse isn't necessary for devastation. A gradual erosion can be just as destructive, perhaps more so, because it happens slowly enough that people convince themselves everything is fine. From 2022 to 2024, central bank gold purchases more than doubled, surpassing 1,000 tons yearly, primarily driven by banks in Asia and emerging markets. Gold as a percentage of central bank reserves currently sits at 19% at the end of 2024, well below the post-Bretton Woods average of 29%. Translation: we're in the early innings of this transition. The diversification away from dollars has barely begun. How exactly would an accelerated dollar crisis unfold? Economic researchers have mapped out the nightmare scenario with chilling precision. A loss of confidence could trigger widespread hedging by pension funds, insurers, and sovereign wealth funds, creating a run dynamic in treasury markets. Banks' balance sheets, heavily invested in treasuries, would suffer losses weakening their capital positions, while money market funds could face redemption spikes forcing fire sales. Here's the truly terrifying part. Such a crisis doesn't require a speculative attack or macroeconomic collapse, only a shift in market expectations and large mechanical flows that stress market infrastructure. In other words, the crisis could be self-fulfilling. Once enough people believe the dollar is finished, their actions to protect themselves could make it so. For ordinary Americans, this isn't an abstract debate about reserve currencies and basis points. This is about the purchasing power of every dollar in your wallet, your savings account, your retirement fund. The money in your bank account is silently shrinking in value, with appliances, electronics, and cars becoming costlier as import prices rise. We haven't yet reached 1970s-style inflation, but if current trends continue, we could see real returns on savings turn negative. Meanwhile, gold has hit record highs in 2025 on continued central bank buying driven by worries about dollar devaluation. Those with exposure to international assets, precious metals, and real assets have seen their holdings appreciate, a hedge against dollar decline. The wealth gap isn't just about who owns assets versus who doesn't anymore. It's about who saw this coming and positioned themselves accordingly, and who believed the dollar would be strong forever. Where do we go from here? The optimistic view says this is merely a correction, a rebalancing after years of dollar strength. The Federal Reserve maintains tools to intervene if crisis strikes. American economic dynamism remains real. The lack of viable alternatives to the dollar provides breathing room. All of this is true. But it's also true that we don't see the main driver of gold accumulation changing, with debt to GDP set to increase as governments show little political will to cut spending or raise revenues. It's true that global USD reserves have declined from 72% to 58% over 2 decades. It's true that trust, once broken, is extraordinarily difficult to rebuild. The dollar won't collapse overnight, but death by 1,000 cuts is still death. What we're witnessing is nothing less than the gradual unwinding of the post-World War II monetary order. The Bretton Woods system collapsed in 1971. The petrodollar arrangement that followed is now fraying. And what comes next? A multipolar currency world, a return to gold, a new digital monetary system, remains uncertain. What is certain is this: the era of unquestioned dollar dominance is ending. How that ending plays out, how quickly it happens, and whether America can navigate this transition without economic catastrophe will define the financial landscape for decades to come. The world is pulling the rug out from under the United States. And this time, when America falls, we may well fall alone. This has been a special report. Stay informed, stay vigilant, and prepare accordingly. The crisis is here. The only question is, are you ready?